Welcome back to Click Capital, your go-to channel for all the latest market data analysis and charts. And a tough day for the shorts here. We've got the SP500 back above 4,000 and the 50-bar VWAP here. We've also got the NASDAQ coming up to the top of its resistance range here. Was on weaker volume, and this is kind of a critical point here in the NASDAQ. Are we going to break out or are we going to fall back down? We'll get into that a bit later. But first of all, let's go check out all the data today. So here's the heat map. Sea of green, except for healthcare, that was green all over the shop. Real estate had a nice pop-up. Financials looked like they could be put in a bottom. Mega cap tech showed up as well. And even the defensive sectors had a nice pop-up today. Economic data had pending home sales come in a bit better than expected month over month, but still down 21% year over year. And oil stocks actually came in a lot lower than expected. So I thought we would have seen a bit more of a pop-up on oil with that, because that kind of reversed the trend that would have been seen recently. And we've got some jobless claims coming out tomorrow. Fear and greed just ticked up 3 points to 40, still in the fear zone there, so market's not feeling too optimistic just yet. Over to options, 1.6 million contracts traded in Tesla, mostly even today on the put calls. Still a few calls up the top here in Tesla and Apple, Amazon, Alibaba. But overall, the put call ratios are around even today. And if you look at implied volatility rank, most stocks are still around their bottom half or coming up to halfway for where their implied volatility is compared to the last 12 months. So typically in bull markets, we'd see these really low, but there's not really a lot of fear out there either. So things are kind of just in the middle here a bit. And the dark pools have had it right. They've been buying this dip, and they're still at 51%. So that's still a little bit bullish and supporting the market. Corporate insiders are not buying though. They're down as low as they have been for over to Fed Fund futures, about the same. 58% chance that we pause at the next meeting. Still no word from Warren Buffett. Doesn't look like he's coming into the banks just yet. And this famous market watcher who called the subprime mortgage crisis is warning that stocks are about to crash. So this guy used to work at Lehman, and he apparently put out warnings at the time that there was going to be a big, mortgage real estate crisis, but was ignored. Now he's gone and created his own company, and what he's done is looks pretty good. He's created all these good indicators, and he's got what he calls his 21 Lehman systemic risk indicators, and currently they're pointing at the highest probability of a crash or a sharp drawdown in the next 60 days, the highest probability since COVID. And he said that investors are ignoring the risk of a rolling credit crisis, and he saw this before with Lehman. What happens is a shock comes in, credit markets start pricing the risk, but equities don't. They focus on things like AI or the dot-com revolution in the 90s. So I thought that was interesting and pretty hard to ignore, because his indicators do look at things like corporate default rate, stock market short interest ratios, investor sentiment surveys, and apparently they're all flashing warning signs. So I think that's important to factor in when doing target positioning. And Electronic Arts cutting off 800 jobs, or 6% of its workforce. So again, another big company trimming their staff, which is typically what you see going into a recession, not an economic expansion, because all these big companies have great data, and a lot of the smaller companies will end up following them. So, okay, over to the charts. So we'll come back to the indices. Let's just go through international. They all popped up a bit overnight, even though they closed a bit earlier. And Asia Pacific yesterday, we had the Nikkei over its 50 bar. Aussie had a great bounce back, and China just kind of sitting flat. Volatility has dived again today. We've got the 9-day down at 17, really low here. So there's just hardly any volatility being priced in the market by dealers over the next week or so. And the VIX itself is now below 20 on a 19 handle and coming down to this big support zone here that we've seen quite a while. We did see it bounce off this level at the start of the year, and it wasn't back until before the bear market that it was last there. So volatility really low down here. Market doesn't seem to be worried at all, although the bond market is still really high. We've got the MOVE index at 150, and the premium of bond market volatility over equity market volatility is still really elevated up here, some of the highest it's ever been as well. So that's one of the most interesting dynamics we've got going on in the markets is bond traders are a lot more skittish than equity traders. Put call ratios were pretty flat today. Haven't had breadth data come in yet, and the spreads had a bit of a pullback today. Still haven't broken out on the growth cyclicals. Equal weight just sitting flat. High beta had a little bit of a bounce today. So did growth versus value, and NASDAQ as well pulled back a bit as well. But looks to be choking around up the top here. Gold had a bit of a pullback, as did the yield curve. And we saw high yield bonds have a bit of a pop here today. And I would have thought rates would have jumped up a bit more now that we've got inflation expectations coming back into the market. If we really are behind this banking crisis, then we should go back to inflation mode. And I would have thought rates would have come up a bit more here today. But we do look like we're putting in a bit of a bottom here on the rates, and all the markets are kind of forming this rounded bottom and all these tails and hammers. So that looks like that could hold, and we could see a further pop back up in rates. Fed fund futures as well look to be creeping up to where they had been finding resistance over the last week or so. And so if this breaks out, this should be bearish for tech stocks, because this pricing was based on banking crisis and that the expectation the Fed could pause or even pivot. They didn't. They jacked rates up another 25 basis points. They're saying they're still going to keep on top of inflation. So if there's no more bank values, then we should see rates come back up, especially as we're still seeing a healthy consumer and jobs market as well. Moving on, treasuries came off a little bit. If rates keep going off, and they actually took out the lows from this gap up here. So if rates keep moving up, then maybe we'll see treasuries fill this gap. And high yield today had a pretty good move here. It was still below average volume, but we did finish up near the highs above the 50-bar VWAP. So definitely a bit of risk coming back into this market here. And the dollar just holding down here at its support level, and Bitcoin creeping back up. I've got a feeling we're going to test that big 30,000 level. If we look on a weekly chart, that's been turned a few times. So I've got a feeling that maybe later this week into the weekend, we'll test that 30,000 level, and it might consolidate there. Over to commodities. Commodities just holding up there as well. Copper up in a resistance zone. Gold consolidating, looks like to be a bullish flag here. And oil just sitting around its 50 bar as well. Looks to have reclaimed this support zone. And I think Warren Buffett's right with his further purchases in Occidental Petroleum. I think he's buying the dip on oil, and I think it could be a good time to get back into oil here. I mean, we've consolidated now for over a year, had this big pullback, and with all the geopolitical tensions, and if we just go to the crude oil futures contract, which is a better way to look at the price of oil long term, go to a 3-month chart. So it's been consolidating. We've gone sideways for 15 years now, and if clean energy policies, they're restricting the supply so much, the world's still going to need oil for, probably many more decades to come. We could see, and Warren Buffett could be betting this as well, we could see the mother of all rallies in oil that surprises us all as we go into a clean energy world. But if we get oil to, $200-300 a barrel, that might help the world switch over to green energy, because the price differential between oil and clean energies. But until then, with the restricted supply and decreased production and investment in new oil supply, that could be really supportive of the price of oil. So I think oil should have a bit of a tailwind on it for some time, and may hold up better than we saw. It did crash in the GFC, but it had a big run up going into that. And if you look in the tech crash in 2000, it just pulled back slightly. So right now, if stocks are going to come off, we haven't ripped higher in oil. So I've got long oil in my own personal and some client portfolios. So I think it's going to be well supported. Overall, I'm generally bullish on commodities, but gold and oil especially. And food I don't mind as well. I think food is supportive the growing population, and again, green energy policies are going to restrict agricultural development and supply. So food, gold and oil. Over to stock sectors, see a green out there except for gold miners. So kind of a little bit of reversal of what we've been seeing lately. And tech is kind of at this, the tech sector couldn't break out to new highs today, came within a few ticks of it. And this is either a great spot to short it with an easy place to place your stop, or we're going to break out higher here. We've got the discretionary now above the 50 bar. Semis, let's go out to a 2 week on the semiconductor. Coming up to that resistance zone around that 250 level on semis here. So again, this is a spot where we're either going to consolidate, hold and turn back around, or we could launch higher coming out of there. Biotech bounced back up today, and energy creeping back up, looks to have made a bottom. And financials, we're putting in big divergences on the financials here. If you look at our hidden divergence indicator, we put in this bullish divergence, but you can also use this indicator when it flips from negative to positive, and how strong a negative or positive reading you've got. So you can see the last time we flipped from negative to positive was back here, then we had the run higher. Then back here, we flipped from negative to positive, we had a run higher. So after a deep sell-off like we've had, when this thing flips, this could be indicative that we have made a bottom. And so I wouldn't be surprised if we rip higher here in financials, and if we just do a Fibonacci from the swing high of the move down, 50% retracement will take us a bit above the 50 bar VWAP. So financials could have, we could get that big, 3, 4, even 5% up day that kind of just cleans out the shorts and changes everyone's mind and mood on financials. That could be beginning to happen. And regionals here, we've moved up really strongly here on our indicator. So we could be putting in a bottom here on the banks, and the headlines with banking seem to have calmed down as well. So we could be making room for a bit of a rip up here. And that's not to say we're going to go back to where we were just a month ago, but we could make that 50% retracement and consolidate and go from there. REITs popped up a bit as well, and utilities holding strong. So even the defensives were holding strong today. Got staples up there as well. Healthcare not quite there yet. So pretty green, a lot of bullish breadth across the board there today. And BlackRock as well. That looks to be putting in a strong bullish divergence and forming a bottom here. JP Morgan as well, and mega cap tech right up in that resistance zone. So this is, like I said, there's either a good spot to get short here, or we could be turning back down. Google is a bit weaker. I really think people are underestimating the effect ChatGPT could have on Google in the long run. I think I'm myself personally using ChatGPT more than Google. And once ChatGPT, think about it when they develop your own personal AI that gets to know you. I think Google's way behind in that. So, but that's more of a long-term play as opposed to what price action is doing right now. Meta sitting up there too, just really bullish, and the semis. Nvidia, we haven't taken out those highs yet, and like I said, it's still too early to say we've made a top. There's still bullish momentum in this stock. First Solar as well, we still haven't taken out those highs here. Still have that bearish divergence, but I'll get into a bit more of the semis later. Netflix popping up, and Tesla. I was watching this bearish divergence, but that looks to have failed. And now we've got a bullish divergence here. You can see price from this gap down, it's gone basically sideways, a little bit up. The hidden divergence actually rip up, and now we're at 9 today on that. So again, this will be really bullish for the market. If a big leader like Tesla, if we can break out above that 50 bar VWAP, take out last week's highs, that would be bullish for Tesla and the market as a whole. Coinbase holding up pretty well considering the government is coming after them. AMC, that rumor yesterday Amazon was going to buy them, I think that's all made up. So someone could have made a profit on this pop-up here, probably in tandem with the journalists. And I mean, I'd be so surprised if Amazon took over AMC, largely because they have so much debt. If you look at their balance sheet, debt to assets 128%, total liabilities 11 billion. And then if you look at their cash flows, operating cash flows just in the negative, income is just lost money, constantly losing money. Does Amazon really want to get into that? Does Amazon shareholders going to be happy with that? Because they have to do a huge turnaround to make that thing profitable. I know they can feed their content into the locations, but this thing's bleeding cash. So as an Amazon shareholder, I wouldn't be too happy if they stood in and took over that, especially since it's already trading on a 7 billion market cap. So to take it over, they'd probably have to offer 8 or 9, closer to 10 billion, which I don't think it's even a worse valuation than what it is now. So meme stocks had a little bit of a pop-up there today. Market's feeling pretty optimistic. GE had a few subscribers interested on my thoughts on GE, so I'll just perform a quick analysis on that before we get into the rest of active stocks here today. So on the short term, on the daily chart here, big parabolic move this year. Gapped up at the start of the year. We've held, haven't had deep pullbacks. Gapped up again and held, and not even showing a divergence on the indicator. And range strength is indicating a strong trend there. So let's just step out to a weekly chart, see what we can see. Just walking the line on the buy-sell band. So obviously technically a really strong trend. Let's go out to a monthly chart. And we can see that there was a bit of a resistance around this level here, around the 85, 86. So we could easily draw a resistance box there. And it looks to have clean taken it out. If we go to a long-term chart, 6-month chart, we're now at the same price we were back in mid-96. So almost 30 years of going nowhere. And look at that, the late 90s. It was such the darling stock. It became the biggest stock in the world. And if you look back in history, pretty much every stock that becomes the biggest stock of the world, they never stay there, because capitalism's kind of like capture the white flag. Once they get it, you become complacent, you're too big, then there's more hungry, smaller players come for you and take it off you. So, there's a good chance we could see the same thing again with Apple, like we've seen over the years with Exxon, IBM, and a whole bunch of other stocks over the years that made it to the biggest companies in the world, and it's very rare that they stay there for long. So let's just go back down to a monthly chart. It's formed this consolidation for the last several years, and we looked like we have broken out of that. If we go over to our fundamental chart and to see what we've got, fair value at 72. So we've got stock price about 28% overvalued, business quality score positive but pretty low at 1.2, but it is improving. If we look at their revenue, that's come down a lot. I don't know too much about GE fundamentally, but I think they've been spinning off their units and trying to turn around the business. They do have a strong engine aviation business, and they supply the military, then a bit of renewable energy as well. You can see that quarterly's growing up. The market's probably, been pricing in that better quarter that came in, net income of 2 billion. So if we extrapolate 2 billion a quarter to 8 billion, against that 100 billion, it's not too bad. So this fair value could continue to climb. I wouldn't buy it here, but I wouldn't short it either. I think it's got a lot of momentum in the stock price. It doesn't look like it's top. This looks like a gap that's moved up on volume and held, and there's no divergence. So with the business turning around and coming off that really low multi-consolidation base, it is a little surprising to see, but I just wouldn't short it with this momentum here. So that's what I think about GE. Lululemon gapped up really hard today, retail, even though we didn't beat too much. The market just loved it. And Micron Technology, even though it put in, I think, its worst quarter ever, I think it did a huge amount of write-downs and said the market had bottomed in memory chips. And so the market really liked that, and that spilled over to a bunch of other semis as well. You look at Intel, up 7% today and breaking out here. We'll just go to a weekly chart on Intel. So similar to GE, has been consolidating down, and it looks to have broken out of this consolidation zone on Intel here. Here's our First Citizens that took over Silicon Valley Bank. That's still rallying higher. They did such a great deal on getting that. Deutsche Bank holding on. First Republic still super depressed down here. This thing could have a massive dead cat bounce if it's going to survive. Even if it were to be a zombie, we could still see a huge flush out of all the shorts in this thing. Much the same as PacWest and Western Alliance, but still really risky stuff. I mean, this thing could still go 20% either way. And the banks, look, Bank of America is 9.5 on a hidden divergence. Well, the price is still kind of depressed. So this could be setting up for a massive pop in the financials. I'd say if we don't get any more bad headlines, if we don't get any more big banks in trouble or needing the Feds to step in and things just stay calm. I mean, you look at the VIX market, that's saying everything's good. Option dealers are just not worried. Look at that VIX 19. Who would have thought back here on news that Silicon Valley Bank went under the biggest bank value since GFC, the second biggest bank value in US history. Then a bunch of others, Credit Suisse and First Republic. And then, 2 weeks later, we're at a 19 handle on the VIX. That's got to be one of the quick, if this is true, if the equity market is right, this has got to be one of the quickest resolved banking crises in the history of markets. So who's right? Is the equity market right? Or is the bond market right? Typically in history, the bond market's more right and more of a leader than the equity market. So if that were the case, that would suggest now could be a great time to buy hedges, insurance on your equity market portfolio and look at your positioning. But we can't ignore the price action. We've got SP500 scalped up and held above its 50-bar VWAP, and we've got NASDAQ coming up near our current year highs here. So this could still be a top here. We did come up on weaker volume, and we've got all indices popping up. We've got mid caps, smalls, putting in that divergence on this rounded bottom that we've been watching, and equal weight as well. Equal weight S&P just popping up to those highs from 2 weeks ago, going positive on the hidden divergence here. So interesting dynamics going on in the market. It's definitely a tricky, hard market. No conviction, big follow-throughs, and just kind of chopping around here and popping up here. I've probably been a bit too aggressive on my short positioning, I must admit, over the last week. I have been watching, you've been hearing me say in the channel that we've been looking like we're bottoming here. So I've been a bit too heavy on the short side, which I had to recognize that today as we creeped above the 50-bar VWAP. So I've trimmed my tech shorts a bit and trimmed my overall positioning down to flat, market neutral. So I'm really not sure here. We could just rip through this tomorrow or on Friday, or we could this could be actually prove to be a good short spot. But with what's going on in the bond market, volatility, and the inverted yield curve coming back up, indicating a recession, and that article we saw with that guy with all his Lehman systemic risk indicators, it's just hard to ignore all that. And maybe if we break out, I could tilt a little bit bullish just based on price action, which is, the number one, first and foremost indicator we want to pay attention to. But for now, I'm just going to stay flat, and I think I'm going to stay around flat for a little bit until this market really resolves itself in one way, because it just keeps chopping along here in this really kind of sluggish sideways action. So I think I'm going to keep it more towards neutral until we really break out here. But that's all today. Thanks very much for stopping by, and hope to see you again tomorrow afternoon. Cheers.